Welcome to the Dividend Talk podcast, episode 209. Dividend investing for retirement, building your own pension. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJI. How are you, friend?
Good. Like always, what we say, busy week behind me, but fully loaded for the show from today. And how about you?
Yeah, I'm good. Had an Irish wedding yesterday, so you can probably hear it in my voice a little bit. But
what's special about the Irish wedding? Is it like till 12 or till 5 in the morning? How does it go?
Yeah, I got home at 4:15 in the morning.
Okay, and it's like dancing all night?
Yeah, pretty much dancing. The music will stop at about 2:00, 2:30.
Mm-hmm.
Then everybody sits around tables, and then you sing songs.
Oh, okay. What kind of songs?
Usually, it starts with maybe some Irish traditional songs, and it can be anything, whatever
Nice.
you prefer.
And do you talk dividends during a wedding with people?
We try not to. Funnily enough, that doesn't keep the party going. But
okay, such a pity. I thought there would always be people interested in dividends.
the older people will be long gone. So
pity. Well, good that you're still alive, that you survived. Probably quite some Guinness in your belly. So I hope you'll be able to sit it out for an hour.
Yes, plenty of Guinness, Diageo. I did them proud. We're focused here, so we're good to go. Good.
So what about then the news of the week? Because honestly, I didn't have any time this week. I was so occupied. But how about you?
Yeah.
So I think caught your attention.
I think the big one or the most surprising piece of news came from Nestle, with their CEO. I think his name is Schneider. Decided to step down. Now we've got a couple of questions on this from Andy, JC, and Alexandros about our thoughts on this. But it was quite a sudden and surprising move, I would say, which makes me wonder. I listened to the call and it didn't give much away, to be frank. But
yeah,
it definitely seems like it was not planned by Schneider. It seems like that he was ousted because it was a little bit too sudden. I read some commentary online on the internet then from some of like these managing partners and investment firms, and they're talking about how he was seduced into doing too many deals, chasing growth through expensive acquisitions, relying too much on price increases and all this. So I'd say the board are not quite happy with it. And it made me wonder, actually, has Unilever's little bit of a turnaround, has that inspired the board? Are they looking at Unilever, because they're big competitors of each other? So are they looking at Unilever saying, okay, they've changed CEO, they've implemented this plan, they're targeting growth, they've seen growth. We're not seeing growth, we're only increasing prices. We've got a weak consumer. I think their shares dropped 10% compared to Unilever's increase in 23%. So I wonder if that influenced the decision somewhere, which is quite interesting. But yeah, it was out of the blue. I think it was a little bit too early. We know we have a weak consumer at the moment. Danone is not doing a whole lot better than Nestle. It's still performing better than Nestle, but they're also competitors. So But it seems like the board were not too happy and just yanked them out straight away.
Nice. So honestly, I don't follow Nestle. It's the number one dividend growth stock in Europe when it comes to duration of consecutive dividend growth. But I just don't follow it because I just don't like the business. I mean, I like the market that they are in, but I don't like how the company is doing, both from a valuation point of view, both from how it has been leveraging up without growing, the direction of management. So I've never really liked it. So I've not even a clue who the CEO was, because if it just doesn't hit your screener criteria, why even spend a single second on it, right? I did an analysis like 4 years ago, and I felt already like, So, and that hasn't changed. So who knows? For me, this company, I also wonder always, like, how much bigger can you still get than Nestle? Yeah, and where should their growth come from? And I don't necessarily have a feeling that a new CEO will suddenly turn that around. But hey, who knows? There'll be enough time to step into it if needed. But for now, I don't see how the company will do significantly better 10 years from now than today. I just don't see it. And if I can't articulate it, I'm staying away from it.
Yeah. And they suffer. Obviously, they're in the Swiss francs, so they suffer heavily with currency, and it makes it hard to analyze because we try and ignore currency, but it's such a huge part for them that it impacts, and it's been impacting them for 10 plus years. So it's not a once off. So at what point do you say that it is a strong mark against them? So yeah, I'm like you. I looked at them briefly over the last year. I didn't like how they were using debt to fund buybacks, as you said, financial engineering, and the lack of growth was definitely concerning. But still an interesting piece, especially as they're one of Unilever's competitors. And I have a feeling it was based on Unilever's growth that this came out. So
let's see. They seem to have a home grower appointed now. That's what I understood. Someone on the Facebook group mentioned that. So let's see. I mean, I wish them to do well.
Yeah, of course. Number one consecutive dividend increases.
Exactly.
And what about Jerome Powell? I didn't hear, I didn't see it, but I know he must have had a speech because I got a little notification on my account to say that it increased by X amount. So it must have been good news.
Well, usually we don't speak about all this kind of stuff, right? Well, really sometimes, but in this case, they have this kind of annual event where all those central bankers come together, and then kind of once a year they discuss all kinds of matters. And nowadays, many people are looking there for the speech. And the only reason why I brought it up, because seemingly now is the time that they really want to start cutting some interest rates again. So I don't know how much, but this is good in that sense that the companies that have a bit more debt in our portfolios from the US will start to loosen up a little bit again. So think about the real estate sector. From the other side, I wouldn't mind buying more. Yes, so I don't like so much that they are doing it so quick. I don't have all my positions fulfilled yet. Yeah, but inflation, they say it's back on a sustainable path to 2%. Employment rate has been rising, so also therefore they could be a bit more, with lower interests. It was also interesting to read about how they looked at the inflation, that it was really because of demand supply shock plus the war in Ukraine. And that's why it's so hard, this market, since the last 4 or 5 years, because these are events that are not normal. Yeah, such a like a COVID that happened, like the last time was the Spanish flu. Yeah, so to see such a demand shock and such a ripple effect is really interesting, and we see it also in the IT market, right? Many people were hired in 2021 during that boom, and now companies are all looking at what they actually hired and trying to find synergies and putting a bit of fat off the bone again, right? So I'm not surprised that the market is also tightening a bit for new jobs. So I think it means that I think towards next year, if they really start to lower the interest rates like in Europe, that stocks will become much more valued again and overvalued, and it will be harder for us again to find those needles in the haystack. So I'm not really looking forward to such a situation.
Yeah, yeah. I mean, look, I didn't hear the speech, but I would have guessed that he mentioned interest rates are going to be coming down with the way the market reacted. But imagine holding that much power. I mean, who's making? There must be someone making money off his speeches. Somebody's proofreading his speeches beforehand and going, "Shit, okay, invest, invest, invest. I'm going to
Yeah.
make a load of money." Yeah, but
I'm sure that they are not allowed to trade.
yeah, oh, of course, yeah. Of course, they're not allowed.
Yeah.
They don't do this, but yeah, let's see. REITs have been hampered for the last 18 months, so I know you're saying it's quite sudden, but some of these they need a bit of relief on their balance sheets.
Yeah,
And
but I was not done yet with Agree Realty, yeah, as an example. And I also think about the insurance company that typically have debt on their balance sheet. I am not done yet with some of the companies like ASR and such. So, you know, yeah. Well, hopefully another sector gets a beat up so that we find some good dividend growth stocks there.
yeah, yeah. Thinking of dividend growth stocks, let's mention some recent dividend hikes. You said ASR, well, they've raised their interim dividend by 7.4%, a little bit less than NN Group, but still quite a raise when you consider that the yield is now nearly 6.5%.
Yeah, but they just pay out the 40% of the dividend of the total dividend from last year, so it was to be expected. And yeah, it's a nice dividend hike. So I'm really looking forward to the end year results and what the dividend will be. What was interesting for me is that the Aegon acquisition is really doing them well. They are back again on the solvency ratio close to 200. So for me, the underlying business was really doing well. And yeah, 6.5% dividend yield plus such growth easily makes it easily hit the chowder roll of 12. So yeah, and then this just return for people, right? What they can expect. So I still expect generally maybe not in dividend growth. I don't know, of course, but I do think that this company at least the next 2 years can still grow double digits. Yeah. So that will be beating the average stock market. I think this stock has this potential. Let's see if it plays out, of course. But yeah, let's say differently. I'm having high expectations.
Okay, good. Well, talking about the chowder rule of 12, there's another company, Altria, ticker symbol MO. They've had another 4% increase. I think that's 3 of the last 4 years. It's been 4% increase on top of the dividend yield of about 8%. They've increased it to $1.02 quarterly. Tobacco stocks have been on fire this year. I know you don't invest in them. Obviously they are quite cyclical. They're under pressures, but I mean, I look at Altria and it is trading at $52 at the moment. That's nearly back at the highs it was in 2002. So doing quite well. Another hefty dividend increase. So look, everyone knows the risk. This is just pure income. So yeah.
I liked on our Facebook group one of the members said like, "Thank you to all smokers." It was so funny because we can't take this serious. Well, no, we need to have some fun as well with investing, right? Specifically around sin stocks. So this was really, this was a nice one.
Yeah. And then the last one I noted is a competitor of what's the company called? CME Group. So it's CBOE Global Markets. They raised their dividend by 14.5%.
Ooh, that's quite a kaboom.
Yeah. So they're doing quite well. So I wonder if the CME Group would do something similar, but they like to do special dividends. So
yeah,
let's see.
And what about medical properties trust? Have you heard that?
No, I'm guessing. So I saw a post saying FU, FU MPW on Facebook, and I'm guessing they cut the dividend. Yes,
46%.
Oh man, 46%. I mean,
Yeah.
I can't say I'm surprised if I'm honest.
No, me neither at all. This company is just in trouble. That's nothing to do with dividend growth anymore. This is just like pure speculation, I think, because anyone thinking they understand the situation really well when being in Europe, right? Yeah, because the issue is you can't trust the public information anymore. Yeah, because management, let's say like that, has been looking at this situation very naively.
I'm wondering, and I'm just trying to check quite quickly, has our friend Chuck made an update about these? Because he was quite bullish when he was on the show about them, but honestly, since then they've been garbage, and now they've done this as well. So I might reach out to him and see what his thoughts
Yeah,
are.
this may be the classic example of a value trap, where based on statistics it looks like value. Management is positive, so you feel like, okay, once the value is unlocked, but maybe this company is just broken, really, really broken, and beyond repair.
Yeah, but look, I think if you invested in this company, you have to be honest with yourself and say you are 100% chasing yield, 100%.
Yeah,
Because
yeah, yeah.
I don't see any other case for this company. But
True.
46%, that still gives them probably around a 7 or 8% dividend yield. I think, is it still quite high? I would say.
Exactly.
Yeah. Wow. I'm glad stayed away from that one. So pensions is always a topical conversation. I don't know what it's like in Europe, maybe the Netherlands or Poland, but in Ireland, it is extremely topical. And pretty much because it's the best way to invest with regards to taxes in Ireland. So it can be quite topical, especially if I tell people that I don't pay too much attention to a pension, or rather dividend investing. So we have our own show on building your own pension, and I'm curious to hear your thoughts on it. First of all, do you have a pension? Why do you have a
Yes.
pension? And is it part of your
So
financial plan?
yeah, I still have something in the Netherlands, a small pension, because I work there. Then I've got my pension here in Poland. Unfortunately, it all goes to the government. So, to be honest, it's that's how to say it nicely. I just don't have any trust that there will be ever money money waiting for me in 25 to 30 years. I mean, that's first of all, they pay relatively poorly here in Poland. Secondly, people in the ministry and probably offending a lot of people now. The ones that I interact with are usually not the smartest. There's a really, really strong incentive for the smart people to work in a commercial company. So, yeah, but we're giving the money to the yeah.
We talk about unsalted European flavor. There you go. But yeah, like
Yeah, it feels like you know what to do with your money. You know how to give a return, and then you give it to governmental institutions. That are
But there you go, right? I'm looking at the pain on your face right now. But we've only spoke about 3 countries in Europe:
yeah,
Ireland, Netherlands, and Poland, and we've got 3 vastly different ways of how
yes,
pensions are managed or handled. So you can imagine that we've got people listening from Denmark, Spain, everywhere, all
yeah.
across Europe. So it's going to be different in each country. So I think that's important to
Yeah,
note.
but I do believe that the distrust in the pension system will be quite a
Yes,
common pattern.
yes, of course, but the benefits and the cons will be different in each case. So
Yeah,
just as a disclaimer, this is our experience from our pensions in our
yeah,
countries. Yours might be different, but I still believe that taking control of your financial future or your
yeah.
independence is definitely important, and that's why I prefer to build my own pension.
Well, you actually just reminded me. Like, I was watching Forrest Gump yesterday with the family, and he has like an IQ below 80. But I think he did a shrimp business after Baba died. So, and it made him a multimillionaire. So, yeah, maybe there's someone in this ministry that invests somewhere in a shrimp business. Yeah. So if that's happened, then we may still be good. But hey, if you look at Poland, for instance, right? In Poland, so your retirement, that's one part, but then you can also invest in a retirement account called IKE or IKZE. In the IKE, you can put around 4 to 4,500 euro annually, and in the IKZE around, let's say, 1,700. The nice thing about the second one, the IKZE, you can deduct it from your current income tax. So you have then a nice benefit that you pay less tax, and you can use that money again to invest in something else. Yeah. And both accounts are also exempt from capital gain tax. So it's really a tax-free account that you can invest in. Of course, one is available from 6 years old after a certain amount of investing, and the other one from 65 years old. And I think that's a nice way of taking some initiative, right? Some accountability for yourself as well, and invest there. Now, we do this not on my account, but on my wife's account, because it's generally a lot of money, right? It's like almost 6,000 euro, let's say, a year that you can invest. And my goal is not to wait till 60 for this. So that's why we're not leveraging it entirely. But, we would be too stupid if we wouldn't use it either. Yeah.
Yes. Yeah.
And on top of that, sometimes your company can still have like a pension investment account, which is in my case, and you can have there what you know from the States, like an employer matching or something like that. Here, so there are at least options to still invest for retirement using tax advantages, investment opportunities. And is that something similar in Ireland?
Yeah, we've got there's pretty much for an individual like myself, like a professional, there's two options. There is other options if you're directors and so on, but I'm just going to take the typical case. We've got what's called a standard PRSA or retirement fund, which is what most people would be in. You can invest in this, your company can match your contributions, but the problem is you are relying on companies to invest for you. So they give you these like lifestyle balanced funds or growth funds or whatever, but you have no real control over what they're investing in or how they're investing in it. So you're just relying on them. It's like a managed fund for all the world. Still better, in my opinion, for someone who doesn't invest to be in these than in nothing at all. Dividends is tax-free, capital gains is tax-free. Basically, everything is tax-free, and you also get tax rebates based on your age and your contributions. So it increases your tax rebate, increases the older you get. So there's these bands. So it's as you said, it's a no-brainer to have these, especially if you're in the higher income bracket. If you're in the low income bracket, you don't save as much. But definitely, if you're paying 40% tax, you need to be in these. We do have non-standard PRSAs, and that would allow me to invest in dividend stocks, buy a house, or so on. And I've always been tempted, should I be doing my dividend investing inside one of those? Because again, tax-free dividends, tax-free capital gains, and you get the same tax rebates as well. But the problem is the fees are uncapped there. So there's no control over what they can charge you. And I feel like for someone in my income, which would be just above average, say, in Ireland, you're priced out of this market. They want people on lots higher. Like there is options. We have Davy Select, but the fees have increased. They've increased again, actually. So they're kind of pricing you out of the market. So
that's the issue as well, because they know that the money is parked there for probably the next 30 years. So they can lure you in with attractive rebates, and then they just take a certain percentage of your return, and that's free money for them. I mean, this is why bankers are wankers.
Exactly. And there's nothing stopping them from increasing it every 6 months. You can do nothing about it. So it's
exactly bloody thieves. So what is interesting for me, right? Like, why even invest for retirement? Because many people, they don't invest for retirement. They just say like, I pay my share via the social tax. Let's say it's invested in the retirement scheme from the government, and that's what I will get. I have my house. We will be paid down after 30 years. So what would I still need? And there are some remit in that, provided that you sell your house then or something like that. But other than that, I would say it's tough. For instance, if I see when people get fired when they're 50 plus, how difficult it is for them to still get work, right? So I think when you're, let's say, on your top earnings around your late 30s, begin 40s, yeah, maybe towards late 40s, I would suggest to not extrapolate your current salary into the future all the way till retirement. Some people will do that, but I find that very risky. I've seen enough in our industry of people that got fired when they were 52, 53 and had to do some consulting, but it had also really a severe earnings impact. Yeah. But then also, if you're then, for instance, a consultant, self-employed, you're not having either anymore those nice, let's say, 10% of your salary, right? That your former boss was paying. So people can therefore also easily get a pension gap. Yeah. And this is really something that people need to be aware of. But I think most people just assume like, okay, I will get my retirement, I will get my I have my house, haven't opened an envelope about their pension scheme over the last 30 years, and then get this awakening right at the time. So for me, I think the first two steps I do think similar. Like, okay, I do get a retirement, I do have my house, yeah, but that's why I still look for a different passive income stream or a different next income stream. And what I like about dividends in general, while they are coming in already, they are taxed better than income. So, for instance, on an income level, if it would be income from employment, from work, you pay, I don't know, 35, 40%, yeah, let's say. But on dividends, I pay 19%. So it is much more efficient. And of course, because there's risk, right, in investing. That's why capital is at risk, and that's why typically governments tax them lower than income from work. But also, companies tend to grow faster than inflation. Yeah, specifically if you take the blue chip companies. So if you look at that, what I like really also about the dividends, provided that I would not retire early or something like that, but just imagine that you discover this at 55. Yeah, that dividend investing is a thing. I really feel like you can still build up a nice cushion that you can use during retirement. Some extra money so that you are not, for instance, living on the bare minimum. Because fact is, and I mention that often, over the last 10 years, pension funds have hardly re-indexed or been able to re-index their your let's say obligation that you have in money compared to inflation. Inflation has easily outpaced the pension funds by 15 to 16%, sometimes even up to 20%. So that's how is it? That's just like quality of life that you lost in a single decade. Yeah, so replenishing this with dividends is really a good one. You can do it also differently with buying an apartment and putting tenants in it and such. In this case, we have the Dividend Talk podcast. So yeah, that's for me, bridging this inflation gap is actually also a very, very important one.
Yeah, I think so. But I think it also gives you more flexibility on when you want to retire. If you
Yes.
want to retire early, as you said, and I've seen this in my industry as well. When you get to a certain age, late 50s is probably a good number. If you get fired or made redundant, it is hard to get into the same role somewhere else because
Yeah.
let's face it, there's risks involved, and they prefer to go with the younger generation. So I think having something in place for that case. So if I'm able to retire by 55 on my dividend income, it means that if worst case happens and I'm let go by my company at that age, I can still live comfortably. Whatever's in my pension, I'd consider that as a bonus. If I'm then lucky enough to make it to 68, I think it is now in Ireland, I will then get an old age pension on top of that, which is not enough to live on in Ireland if you're waiting on that. So
Yeah. So I wouldn't be surprised. So in the last, I'm now working for, let's say 19 years, 18, 19 years. The retirement age went up by 2 years, let's say. I could see another 20 years in front of me that the retirement age increases another 2 or 3 years till 70.
easy.
Yeah. And I'm not sure whether I'm with the statistics also then of the average age. Yeah. So all I'm trying to say is like, I mean, so I feel like society cannot afford it to have people going to retire at 65 or 66 or 67. We have a lot of this whole baby boomer generation that has been retiring and continues to retire. Means that that there's less of a working population. That means that and because our pension systems typically work like that, that the current working population is paying directly for the retirees right now. Yeah, so there's just a discrepancy, and I think that, and the population, there are not so many babies born, right?
Yeah.
So that's why the incentives should be, yeah. If everyone would just make more love and don't use rackets products so much, maybe that's what we should do. We should short racket benziker all the way to zero, and do our continent a favor by helping population growth. Yeah, that's what I think we should do. Maybe that's a faster path to wealth for us. But if you think about it like that, and you take these trends into consideration, and you know that pension funds were not able to keep up in a money printing world, right? A zero interest world. It just means that it becomes only harder and harder and harder and harder to live a good life at that age. So societies will probably demand the elderly to work longer, yeah, and
Yeah.
give them incentives to continue working till your death. Well, I don't know about you, but that's not how I dreamed about my life, that you can only live once.
No, no. You get to a certain age, and you want to be able to enjoy yourself, enjoy your grandkids,
Yeah.
enjoy the time around you. And if you are in, and I know the professions we are in, and I know how
Yeah.
fast paced they are, but
Yeah.
do you imagine doing that at 70 years of age?
No. I remember when going to America, and I went to a Wendy's, and there was an 80-year-old lady cleaning the tables. I mean, I can't see myself at 80s here at the local McDonald's just cleaning the tables after some of those brats that are like 20 years old and making a mess everywhere.
Yeah.
I can't see myself doing that, really not.
So enough about pensions then. What about constructing your own one? So how do you go about doing that? Are you considering just dividend income, or is there other methods or
Yeah.
insurance?
So let's say, like, my people that follow me knows that I want to retire early. I'm not to, well, at least be financial independent early. What I will do exactly, I have like 3-4 different dreams there. Let's see how that goes. But at least I will be financial independent in a few years. But there are things like, for instance, really, really simple. Would you consider life insurance?
I've never considered it, if I'm honest. It hasn't
Yeah.
crossed my mind.
Yeah. So life insurance is so first of all, I think that the packages are criminal. Yeah, let's start with that. How is it? But we get rich from it, yeah, via the dividends that we receive from our insurance companies. But there's one thing that you can do. You could just, for instance, put your house as a collateral in your late 60s, give all the money to your kids, whatever you want to do with it, and then have a life, so pay in a life insurance, and then use the life insurance to cover your last years. Yeah. So that's something you could do. Yeah. So because we're getting some money from the government. Yeah. A little bit. We will I said maybe get something from those tax advantages accounts that we opened, yeah, plus dividends. But most people don't. But when you analyze that, let's say not most, but many people don't get to spend it. Their wealth actually even continues to grow in retirement. Yeah. So what you could also do is, like, take all this wealth out, distribute it to your kids way earlier. We spoke about that also another time here. While you can then use tax advantages that in some countries maybe you can gift 100K per year for a certain amount of years, right? And then use life insurance that you buy to just make sure you don't get out of money before you die. Yeah. So it's something that I sometimes think about. But I think I still have a few decades to really think about about it. But that's something that I could consider still doing.
Yeah.
And even more because Ron, a frequent listener of us, he recommended the book Die with Zero. I read it. It was even mentioned in there as well as an option. So it's strength. Oh no, let's say like that. It brought up this strong thought in me again. Should I consider this? But then also, for instance, real estate, right? I'm just thinking sometimes, the housing prices will increase, hopefully. Yeah, who knows? Maybe not if so many houses come available on the market if all these elderly pass away. I don't know what economically will happen there. But for instance, could you see yourself taking equity out of your house and to live on that during retirement?
Yeah, that is something that we've looked at, and only recently we've started looking at that as an option to see how we would go about that,
Yeah.
what the process is. And I know we're a good bit off that at the moment in our stage of lives, but it's something that I must have read or saw online or something about taking equity, and it kind of piqued my interest in how is it possible? Can we do it? So
Yeah.
I contacted a bank last week actually just to see what steps we would need to do to take
Yeah.
equity out of our house, and it's basically just reapplying for a new mortgage. That's all.
Okay.
Remortgaging
But
your
can you
house.
do that as well when you're 65 or 70?
Yeah, you can. Yeah.
Yeah,
Yeah.
but do they then give you really high interest rates, or they are like, as long as you're on the 60% loan to value, you should be fine?
I'm pretty certain it depends on your loan to value.
Yeah.
It's based off that. So
Yeah.
that's the way that they positioned. We didn't go with an official application, but that's how she explained it to me on the phone. That you're not penalised. You're just remortgaging, and then depending on
Yeah.
your loan to value, your interest rate is a percentage of that.
Okay. So that's also an option, right? But I would, if I sense what my path so far has been, will be mostly dividend stocks. I could imagine at a certain moment. It depends also how the world evolves, right? That I would start investing a bit more in bonds, but for now I don't need that. If I will retire early on dividends, 25 years early, let's say, or 20 years early from retirement, and my dividend income would continue to grow, I think I may not need anything of that. Yeah, but I'm thinking more like people that are now in their late 40s, maybe early 50s, thinking about this. Just giving a few options, because we talk a lot about dividend investing, but I think investing in bonds to protect your wealth. The interest rates are quite good now. Yeah, if you take now a 10-year bond, for instance, life insurance is an option, but I would really watch out with that in general, because you pay for that. Yeah, you really get a poor return in the end, probably lower than inflation, but you effectively you buy income. Yeah, and if you live longer than the expected day you should die, according to the averages, you kind of start to benefit. But it's really for peace of mind. You buy yourself insurance here.
Yeah.
That's what you do.
Yeah. That's the one thing I dislike with financial products is they're always so difficult to interpret how much it's going to cost you. They have fees hidden within fees. Sometimes it's front loaded, sometimes it's back loaded, sometimes you're spreading the cost. And I'm going back to pensions here. Like, there's a website, Pension Authority in Ireland, and it'll give you a list of all the pension available to you and all their fees. But they're all different. So how do you compare apples with apples, and how much is it going to cost me? And I hate. You know what? This is why I hate banks. I'm going back.
Yeah.
I'm jumping on the bandwagon. Bankers are wankers, and I'm on it now.
Yeah, that's the reason also why NN Group had these usury policies and this court at the Supreme Court, right? These lawsuits, exactly for that reason. Yeah, bankers are wankers. It's as simple. So you know if you ever take a banking product that they're stealing from you.
Yeah, somewhere along the line.
Somewhere, yeah, left or right.
Yeah. So yeah, I honestly think real estate will come into my retirement at some stage. Mainly when my own house is paid off, I might start looking at other houses, and purely because I think I've mentioned this before. My wife is more comfortable owning a house than she is investing in shares, and it's something that we'll probably use in her retirement fund. Although she does invest at the moment in a couple of funds, which is quite good. But I think real estate, it's something that she can manage, look at, feel, touch, go into.
Yeah.
So it's a lot more easier for her to understand. So
Yeah.
yeah, real estate will definitely come in, but that's more so on my wife's side. And I'm
Yeah.
always quite clear that we should both have different pension, our own pension strategies,
Yeah.
because I don't know how long I'm going to live. I don't know how long my wife is going to live. So we have to be prepared. So that's
Yeah.
the way I
Hey,
look at it.
and let's now then also get back to the dividend path, right?
Yes.
In the end, this dividend talk as well. When you think about building your own pension, and I know we have touched on this a few times in other shows, right? But how would you construct your dividend part of the portfolio? What about sector diversification? What about geographic diversification? How do you deal with the currency risk that you have?
Yeah. Yeah. And I could see myself. I don't think I changed because I'm pretty much 50-50 with Europe and US at the moment. And I don't see that changing purely because
Yeah.
the US has better opportunities to invest in dividend companies, but there's some pretty good European companies here as well. So I couldn't imagine myself going 100% European unless I was completely confident in those portfolios. But I think having a bit of diversification there is not too bad of an idea. Constructing it in terms of sectors, I would definitely go a lot more conservative. I would go with the typical defensive model. Consumer
Yeah.
staples would be high, healthcare would be high, and probably some real estate as well, which I know is not typically
Yeah.
safe, but I would probably gear towards those three. But the world changes. We don't know, and what I fear is knowing how my mind operates sometimes. By the time I get to that age, I could be investing 20 or 30 years. So be like, I know better. Why will I go completely defensive? I'll stick with X, Y,
Yeah.
and Z. So I'm open to change on that. But in my mind, I would prefer to go a little bit more defensive when I'm in retirement. It's just
Yeah. For me, would be the same. I would definitely take out some of the technology, maybe,
yeah,
because it's just subject to disruption a bit quicker. So I would also take more consumer staples. I think I would stay almost entirely out of industrials and material.
yeah,
Telecom, I would not be in. So it would be probably centered around consumer staples, healthcare, and some technology with a white mode. Yeah.
yeah. I
But yeah.
I'd probably reduce my exposure to energy because of the cyclicality nature
Yeah.
of it.
Yeah. True.
Because if at some point, because we don't know what happens, but if I need to access that money, and we've always said it, the times you need to access that money is usually when something happens in the market,
Yeah.
it's down. And if that's in a cyclical nature, I'd rather just be safe and keep
Yeah.
the ones that don't drop as much. So I'd probably thinking about it, I would reduce my allocation in energy, and
Yeah.
consumer staples would definitely be top of my list.
Yeah. So, in the end, is your pension part of your financial plan? I think you mentioned already a little bit.
Yeah, it is. It is, but it's not my main part. It's. I'm going to see it as a bonus when I get to that age.
Yeah.
That's the way I see it. But I will have other means. So my primary means is dividend income. Then I've mentioned once we pay off the house, which we expect over the next decade, say, um, we'll have rental income as well. So they'll be my two main sources. My pension will be a little bonus that I'll award myself, and then if I get to the old age pension in Ireland, that'll be another little bonus that we get.
Yeah.
So
So I don't count my pension at all in my financial plan. I just have written it down to zero.
yeah, okay.
So whatever I'll get, I may just give it away. But and that's why you saw my painful face. I really feel like I'm throwing away money. Yeah.
Yeah.
I really feel like it's going into shithole. And if I will ever get something out of it, well, I just buy a lot of tequila for it.
Yeah, I don't feel like that because if I didn't invest my money in the pension, I would be paying it in tax. So it's free money. So I'm losing that money either way. It's
Yeah.
tax or goes into a pension where I'll possibly get something. So
Yeah.
either way, it doesn't matter. It doesn't matter.
Yeah.
So it makes no sense to not have the pension. So no, I do count it. But as I said, it's more of a bonus feature than
Yeah, I mean, we are maybe also actually regarding this topic not the most representative, because we will, if all goes well, be financially independent way before the retirement date.
Yeah.
But still, I have two quick questions for you. Do you aim to withdraw from your principal during retirement? So what I mean to say is like, okay, your dividend cover, let's say at 60, 65, 100% of the income that you need. Would you take the dividends, but also, for instance, allow yourself a little bit more by also just starting to sell stocks?
Possibly, but do you know, my goal is to match my current income, which I'm
Yeah.
very, very comfortable on. You know how much I travel. I travel quite a bit. And I still manage to invest 40% of that in at
Yeah.
the moment. So it's quite a comfortable level for me. And that's accounting for inflation as well. So I don't anticipate the need to withdraw money from that. And then if I go back as part of my financial plan, we have the pension, and part of that bonus is that I can withdraw up to 200,000 tax free from that.
Yeah.
So I will, if I need to take money out, I would look at that, because I think there's ways of doing that from the age of 55 onwards. So I would look at that option rather than touch my dividend income. I'd like to just leave that and just live off the income. And
But now then you come to the question of ex-Berliner, or the one of the grandpa's rules, like you don't need to be the richest at the cemetery.
no,
So what about, that was my second question. What about your will, and how do you want to deal with inheritance?
yeah, so as part of my will, I have 2 kids. Everything will be 50-50, split down the middle, and given to them.
Nothing to your wife, but all to the kids?
Oh, well, so the way that it works is that if I die, she's alive, it goes to
Yeah.
her, and then
Okay.
to the
Okay.
kids.
Yeah, I see.
And she has the same will. But that's how we do it. But in terms of inheritance and stuff, I will need to speak to a tax advisor, because
Yeah.
I don't see the point in giving all my money to my kids and then they losing 50% of it to the tax man.
Yeah.
So there has to be ways around that. So as I get older, it's keeps popping up as well. It's something that I will definitely look at, but I still think I don't have enough wealth at the moment to
Yeah.
worry about that. But I will seek financial advice for inheritance,
Yeah,
because
that's it.
I don't want them paying too much tax for no reason.
Exactly.
How about you?
Well, of course, I hate tax, but I know there are people out there that think that inheritance tax should be like 80 or 90% on the wealthy, because they feel like the noble people from 150 years ago, they still have all the money and they get richer and richer. So tax the hell out of it via inheritance, so that we make society more equal again. So I'm afraid that if such people get the overhand in politics, that we need this tax advisor even more early.
And he better be good, or she better be good.
Yeah. So I think, I've been thinking about this already for, let's say, half a year or something like that. But I think for me it will be a combination of dividend income and the 4% rule. That's what I've been thinking lately. For instance, take the whole family for skiing each year. Take the whole family for vacation. Yeah. So if my kids have kids, take them all once a year, twice a year. Withdraw from that principle and make enjoy that life. Yeah, a lot. And again, this was also again strengthened with the book that I read that Ron advised, Die with Zero. So I think I would do that. I mean, yeah, I think I will do that because I will invest in my kids during their life. So hopefully, if all goes well, they will just have a proper study and a future. Yeah, and as such. So why inherit then still a lot? Yeah, if they will be well off. So I rather try to focus on how can I spend as much as possible and enjoy it myself and enjoy it with them. Then that's something that I will prefer. And my will, similar to you, goes to my wife and then to the kids. Yeah.
Awesome. Nice one. So look, I hope that was enlightening for some people. As I said, we're not financial advisors, and if you speak to 100 Irish people, they will have 99 will probably have a different opinion to me
Yeah.
with regard to pensions, but that's just our
And,
experience.
and our thinking changes because we are doing these. We have now more than 200 podcasts, and we touched slightly on these topics before. And I know we were saying slightly different thinking things as well. So I think it also evolves while our portfolio is growing, while
Yeah,
the world is changing around us, while we are getting older ourselves. So
yeah,
I'm sure that if we would do this show 4 or 5 years ago, that we would be speaking differently about it.
yeah, yeah. We're older and hopefully wiser now. That's what we hope. Anyway, let's move on to the listeners' questions. And the Wolf of Harcourt Street asked me a question. I mentioned some time back that my son's portfolio was beating mine. How is it doing now, and what sort of positions does he hold? It's a great idea to get him started so early, so he's curious to how he is doing. So honestly, I don't push this on my son, and he kind of comes in waves. He'll get interested in it for a couple of weeks, and we'll speak about it, and then he might forget about it. And he hasn't spoke to me about it now in quite a while, actually, because I don't want for him to feel forced on that. I do check his account every now and again. Mine is now actually outperforming his. But actually, what the best two positions he has are in ETFs. He's got this artificial well, not an ETF, but the European version of ETF. He's got an oil world, and he's got a artificial intelligence, and they are performing really, really well for him. I think he's after doubling his money on oil world and more than doubling his money on the artificial one, which is quite impressive. In terms of single stocks, he's got, I remember he had like Roblox in there, and he's got Microsoft, he's got Facebook, and those kind of things. So he picks companies that he kind of knows. He came to me recently about some real estate company. I can't remember what it was. And I said, yeah, no problem. Come back to me and tell me why you want to invest in it. He hasn't come back yet. So I'll wait to see how he does with that. But it's money that's still there, it's still growing, even when he doesn't know it. And I think it's actually not a bad thing that he's not looking at it all the time, because I don't want him consumed in this either. But it's a healthy portfolio for his age, I would say, in terms of how much money he has in it.
Nice.
Tim has asked us, when deciding whether to sell a company, you weigh up the opportunity cost versus interrupting your compounding too much.
Yes, but I usually sell a company. Most of the times I have sold a company was that I saw a dividend cut upcoming, or there was a dividend cut. So effectively, if I saw a dividend upcoming, that means like I did my analysis and I felt like the dividend is not safe anymore. And then I don't really look at the opportunity cost then, but there is an opportunity cost, and usually it is like the one that I'm holding will probably not do a lot, so it strengthens maybe the selling decision to buy something else. But it's more like I want to avoid having this double whammy of both a dividend cut and a lot of loss in share price. Yes,
Yeah.
I want to be ahead of that.
Yeah, kind of similar. I don't go out of my way to look at the opportunity cost, but it's there, which is why I'm probably selling in the first place. Mike has said, most strategies seem to start by watching your chosen shares are similar. From a standing start with no experience, how do you choose what shares to watch?
So I assume here it's all about dividend growth investing. I think what you need to figure out is like your own dividend stock screener. So for me, it is like, let's say, minimum 2.75% dividend yield, less than 60% payout ratio, because it gives you some wiggle room in case the company has a bad year, or maybe 2 or 3 years. Yeah, then the dividend doesn't need to be cut straight away. But I also would suggest to look at how the dividend has been growing over the last few years and ask yourself, can it continue doing this? I think if you ask these 3 simple steps, I think you already filter out 90% of the stock investing universe.
Yeah. Go back even easier. Our friend Peter Lynch gave us the answer to this question.
Yeah.
Invest in what you know. I think that is the simplest way to, because I'm guessing, look, you're saying you have no experience, so maybe screeners, you don't know what screeners to use, what to use, and what not to use. but you definitely know companies that you use, that you go into, that you can
Yeah.
feel use their products. So there'll be certain companies that you understand. Let's say McDonald's, for example. Everyone knows you can walk into a
Yeah, but
McDonald's.
there are issues with valuation, right? Many people, they bought what they know in 2021 and they got really burned because of valuation. So I really would also look then at least at the price to earnings ratio. While it's not the most reliable, but anything above 20 should always you should always ask yourself, like, okay, do I really want to have a 5% earnings yield on my investment? Yeah.
Yeah.
Because then really you need to look at the growth part, and that's hard, and that's where really many people burn their hands.
Yeah. Hans de Jong asked us a while ago, he bought some ticker symbol is GOODO, so it's Google preferred stock. It gives him a 7% yield. As it's a preferred stock, it provides more protection in turbulent times. Do you have any preferred stocks? And if no, why not?
I don't have them because I prefer really the dividend growth. Yeah, so if preferred stocks, you also see that the price is hardly doing anything and such. So no, I prefer more the dynamics of the normal listed shares.
Jack Jones.
I treat those more as bonds somehow.
Yeah, I get you. Yeah. Jack Jones has said he recently initiated a position in Hershey whilst shopping for his girlfriend's birthday. Ended up buying her some Hershey chocolate, where she's been fairly loyal to Cadbury's before, and he's never owned Mondelez. Are there any stocks that after buying change your brand loyalties or consumer habits? I can't think of any off the top of my head. No, I can't think of any. Most of my companies are outside of Ireland, if I'm honest. So
I can tell you one.
Go
Every
on.
time when I'm in the Netherlands, I only go to Albertijn.
Okay.
Yeah. So that's, for instance, a really good one. If I buy some snacks like chips, I prefer to buy Lay's.
Okay.
Yeah, because it's my PepsiCo. Yeah, there are a few of those that I have. Yeah.
Nice.
It's not so easy with healthcare companies. It depends on the disease.
Sebastian has asked us if we ever looked into a company called Diploma PLC.
So I never looked into it. Of course, a very interesting name. So what I learned about is that's really it's a company listed in the London Stock Exchange. It's based in London. They are known for supplying specialized technical products and services, specifically in the sector of controls, so including some specialized wiring, seals, gaskets, and life sciences, so consumables, instrumentation. So I looked at this company, and actually it's quite interesting, but the yield turns me off, of course, 1.3%. So what I saw, it is like a 5.5 billion market cap at a 50 PE, so it's a growth stock. Now, 50 PE is really a lot, but if I look at, for instance, the revenue CAGR over the last 3 years, that's been 26.5%. That's a lot, yeah. The diluted EPS growth over the last 3 years was 27%. So this company is on fire, yeah. So this company has been doubling in revenue and in net income over the last 3 years. So they still expect the forward revenue to continue growing by 13, so double-digit percentages. So this yield of 1.3% is low for a reason. It's the valuation, because there's a lot of growth expected in the upcoming years. What is interesting, and that's the dividend policy. You see that as well. They are very articulate that they have a progressive dividend policy. They paid a growing dividend for more than 20 years. What's also very interesting is that they almost doubled the dividend also in the last 3 years. So if they can continue growing this dividend like that, then this 1.3% yield will quickly grow to maybe 2 or 2.6% yield. So the company is really on fire. But I simply can't pay 50 PE for a stock. But it looks very, very, very interesting, and I will definitely put it on my radar somewhere.
Okay, nice. British companies seem to be doing quite well lately. They struggle for a little bit, but the market seems to be turning around. But interesting company. I've never heard of them, considering they do controls, wiring, and gaskets. But maybe it's a little bit more specialized than my niche. Dara has asked us about a company called Avnet, ticker symbol AVT. 11 years of dividend hikes, and it seems like a good way to mix text growth and dividends. What are your thoughts? Again, it's a company that I did not know. Looking into them, they are basically a distributor of electronic components. And yeah, in Ireland, we use a company called Radionics quite a bit, and we use them quite heavily. So it's just a distributor. They have anything you need in terms of electronic components, and they ship the same day. So basically, Avnet is the same as them, only on a much bigger scale. As you can imagine, it's from the United States. They have a decent dividend yield of 2.39%, and as you mentioned, 11 years of growth. Before that, they held their dividend steady for about 5 or 6 years. So they have good dividend policy. My only problem with companies like this is that there's no moat. It's easy to replicate something like this. As I said, we have a small one in Ireland. Maybe in the US they have small regional ones as well, where you can use and potentially grow. So that's my biggest issue with companies like this. They don't produce any products. They don't make any products. All they're doing is reselling products from other competitors. Like you could buy Texas Instruments products on it, for example.
Yeah.
So I struggle to invest in these. They can have their place, but I just think it's so easy to disrupt that market or to have a competitor there. I don't see where their competitive advantage lies. So I would stay away from them. Like I said, we have 2 in Ireland, Radionics. I can't remember the second one that we use and work quite frequently, actually. So yeah, my quick thoughts. Mac has asked us about elevator companies like Kone or Otis, I think.
Yeah, so I've looked a lot into them, but there's usually not enough stable dividends over the many years that I typically look after. So it's a pity because, I mean, yeah, what can go wrong with elevators? But I guess it's cyclical. Maybe it goes with the boom and bust cycle of the real estate market or of the economy. But yeah, you see the products everywhere, right? So it's literally this quote of dividends everywhere. But no, I looked at specifically Kone several times, and no, I'm not interested enough. It turns me off.
Okay, and another question from Emac is: have you ever looked at luxury yacht stocks? So Italian Sea Group or someone like San Lorenzo?
No, let me throw in the Peter Lynch here. Not my lifestyle. I don't understand this stuff.
I hope to get to a stage where I can buy a luxury yacht, but no, I'm not investing in them at the moment. Of the two, it seems like Italian Sea Group has nearly a 5% dividend yield. San Lorenzo is 2.6, but they both trade around the same PE ratio. So value-wise, they're probably similar. But as you said, it's not my forte, and I don't know much about yachts, I have to say. Jean Christophe has asked us about Vici, ticker symbol DG.PA. He's a shareholder, and he's wondering if you've got time to look into them further.
No, not deep yet. Not deep enough yet. So I still need to do that.
Yep. I'm all about Snap-on. They're on our watch list, but have you taken the time to actually look at them recently?
Actually, it's on my. It's how is it? It's on my list, and I'm really seriously considering initiating a position into them.
Nice. Okay, and then the last question of the day came from someone on our Facebook, European Dividend Growth Investor. You might know him, but you have asked, what's the one stock you wished paid a reliable growing dividend? Reliable growing dividend.
Yes.
I would say in my portfolio or just in general?
General.
In general, I would like reliable growing dividends. Someone like Ferrari, because they're unreliable dividends, and that's what stops me investing in them. I'd love to own a couple of shares, but if they were a reliable dividend grower over all business cycles, I would pick Ferrari. Race.
Yeah. Nice one. I have it with BHP, the mining company.
Oh.
I wish them to be more reliable in their dividend growth. I know they're in the industry they operate in doesn't make it easier, but I don't need all, like Rio Tinto, I don't need all those huge dividends. Just pay down your debt and everything. Get this AAA rating balance sheet if needed, and so that you can then just maybe go into debt to pay some dividends across the cycles. So I don't need then a lot, then a little, then a lot, then a little. Just build stability in there.
Yeah,
that's what I would prefer.
Nice one. That is the end of the show. As always, thanks European DJI for all your knowledge, especially on some of these financial services around insurance policies and so on. And to our listeners for the questions, some pretty good ones there. Diploma PLC looks interesting. We'll keep an eye on them. So thank you, and we'll see you all next week.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on the information provided in this podcast.